When it comes to investing in commercial real estate, it can feel like a whole different ballgame compared to the residential property market that most of us are familiar with. But what if I told you that you could have a slice of Australia's top office buildings and industrial warehouses and add it to your portfolio without having to stump up for a multi-million-dollar price tag? Today, we're diving into the world of listed property and REITs with Jason Huljich, Joint CEO of Centuria Group, one of the biggest players in the space here in Australia. Jason's going to demystify commercial real estate investing and share how Centuria goes about uncovering hidden gems in the market today. So whether you're an experienced property investor looking to diversify or you're curious about the different asset classes that are available to you in your portfolio, this episode has something for you. Welcome to another episode of Equity Mates. My name is Bryce, and today I am joined, as I said, by Jason Huljich, Joint CEO of Centuria Group. Jason, welcome.
Thanks for having me.
So you're a returning guest here at Equity Mates.
I am.
You came on a number of months ago to give us an idea of what's going on in commercial real estate. And today we're going to continue that conversation. So to kick things off, Centuria has really established itself as a major player in Australian commercial property. For listeners who might be newer to the space, can you give us a bit of a lay of the land in terms of who you are and also the different types of property investments that you offer?
Sure. So Centuria Capital is an ASX 200 listed real estate fund manager. So we have about $20 billion worth of assets. That's about 400 buildings, about 2,500 tenant customers. Wow. And we invest into 7 different sectors. So of the 20 billion, about a third of our platform is listed and 2/3 unlisted. So if you look at the listed side, we have 3 REITs. We have 2 REITs in Australia, and we have a small diversified REIT in New Zealand. In Australia, we have the largest sector-specific office REIT and the largest sector-specific industrial REIT. So the office REIT's got 20 office buildings in it, high-quality assets, and then the industrial REIT's got 90 industrial facilities in it. So it's about 4 billion in the industrial REIT and about 2 billion in the office REIT. On the unlisted funds, we have about 130 unlisted funds. So there's about 80 in Australia and the remainder in New Zealand. You know, these range from single asset funds. So this is where we started. So we'd buy an asset. It might be a shopping centre, an office building, industrial building, and we'd bring a group of investors in. And we've done hundreds of those over the 30 years that we've been in business. We also have what we call open-ended unlisted funds. So that'd be a fund that has a portfolio of properties, 10, 20, 30 properties. And investors can come into that and have a diversified platform that grows and moves and assets are sold and bought through the investment term. You have a bit more liquidity in those funds. There's quarterly redemption facilities, whereas the single asset funds are usually a 5-year term. So you're coming in, you're buying the asset, we're managing the asset, trying to add value. You're getting a monthly income return from that asset. And at the end, we sell it, hopefully with a capital gain to go alongside your rental income that you've been receiving.
Interesting. So we're going to talk a lot about REITs. So let's bust that jargon.
Sure.
What is a REIT?
So a REIT is a real estate investment trust. So basically, it is a listed portfolio of real estate. Okay. So you have two real types in Australia. Our REITs are sector specific. So one just owns office, one just owns industrial. Yep. You have other REITs that might have retail, office, industrial in the same portfolio. Yeah. So you're coming in, it's like a share. It's listed on the ASX. You can sell it and get your money back in a few days. The share price goes up and down every day. So very different to the unlisted side. With the unlisted side, we value our properties every 6 months. Yeah. So your NTA or your value of your investment only moves 1 to 2 times a year. Right. Whereas the listed, every day that share price is changing.
And we'll unpack it a little bit later in the episode, but really REITs are the way that retail investors can get exposure to your portfolios if they're not going direct.
Yeah, or they can come into our unlisted funds as well.
Yeah, nice. So let's get into, what you're investing in. You said that you're invested across 7 sectors. Can you just give us a bit of a flavour?
Yeah, so our biggest sector is industrial. So we have about 6.3 billion in that space, about 160 individual buildings.
And that's warehouses.
That's warehouses. We have tended to focus on infill. So in industrial, there's sort of 2 types. There's infill, which is the probably smaller industrial facilities closer to the cities. So really good for like last mile and things like that. Yeah. And then you have outer ring where you have the massive distribution warehouses. that are usually 40 minutes an hour out of the city.
Yep.
There's lots of land and the like. So yeah, we're a big investor in industrial, probably the biggest infill investor in Australia. We own retail. We have about $3.5 billion of retail, and that's spread across what we call daily needs retail, so neighbourhood shopping centres where you've got a Coles or a Woolies and 10 or 20 shops attached, and large format where you've got your JB Hi-Fis and your Harvey Normans and those, they've gone very well since COVID as well. We're in agriculture where we own 60% of the market there were for the bigger glass houses around the country. So these are very high-tech facilities that grow, very efficiently grow large volumes of crops within the glass houses. We're in data centres, which we'll talk to a bit later. We're in private credit. So we have funds that lend money to investors and developers. And that business has been very strong over the last 4 or 5 years. Yeah, so we're really well diversified. And healthcare as well, so we're in private hospitals. So we're really well spread and diversified across the different sectors.
Wow, 60% of glass houses. Where are the glass houses?
Basically in most states. So we're in South Australia, in New South Wales and Victoria. These are big facilities. So these range sort of from 20 to 40 hectares under glass. We own one that's about 33 hectares. That one is 8 times the size of the MCG under glass. And very, very high tech.
And these guys are supplying Coles and Woolies.
Yeah, exactly. And mainly tomatoes. That's the one crop that works really well in them. But basically in the same amount of space, 1 square metre in a glass house versus the field, you're growing basically 10 times the amount of the same crop.
Wow.
Because you can go up and you've got the perfect conditions and you can grow all year round. And so there's a lot of benefits to it. And it's probably the top of the pyramid when you look at technology and agriculture meeting.
Wow. Not to go down a rabbit hole in glass houses, but are you going out and finding the appropriate areas and building the glass houses to then bring in tenants, or are you going out and trying to buy existing to wrap it up in the portfolio?
So what we're doing is mainly buying existing. And usually you'll have a really good operator that owns and operates that glass house, and usually they're sale and lease backs. And you see this across all sectors. So you have owners that are the operator as well, and what they say is we'll take a lease over it and you buy the asset off us. And with glass houses, they're usually very long leases, 15 to 20 years, and they're very expensive to build because of the technology. But the one good thing is if you've already got an existing glass house, to actually expand it is quite efficient. So we're looking at expanding some of the existing facilities we have.
A few more glass panels.
Exactly.
So in research for this episode, Jason, I read that your team has been described as opportunity hunters when it comes to investing in property. I guess, what is your investment portfolio or your investment philosophy? Why does that sort of resonate with your team? And do you have any, recent acquisitions that illustrate what that actually means? Yeah,
look, we're what's called value buyers. So we're always looking for value. When we started back in, close to 30 years ago, and we were just doing these single asset funds, right? So we'd buy one asset, we'd bring the investors in it, and that's the fund. So you had to be very careful. That building couldn't stuff up, right? Or that fund was stuffed. And probably a lot of our peers have focused more on the portfolio funds where you might have 20, 30, 40, 50 buildings in them. But you sort of don't know what's in there, and one building goes good, one building goes bad, it balances it out. So there's more room for error. But because we came through that training of we've got to look at each asset by itself and make sure it's a good investment, I think the team's really well placed because even though now we have some portfolio funds, we look at each asset on its merits, where the risks are, where the opportunities are. So if you look at recent sort of examples of this, I'll give you one divestment and then one recent acquisition. So divestment-wise, we just sold the final building of a fund we had called Australian Technology Park Fund, which owned 3 office assets. So Australian Technology Park was a government-initiated technology park it was Redfern, it's now called Everleigh or South Everleigh in Sydney. And they built this park and it was going to be a tech hub, but this was 25 years ago. And it never really took off. There's a few government buildings there. Channel 7 ended up going there and building a facility, not for their head office, but they had some of their studios and some of their divisions out there. That building came up for sale. We bought it. We went out there, and it wasn't a great suburb at the time. There wasn't a lot of workplaces that wanted to move to Redfern as a location. But what we saw out there was value. So we saw the rents, and the rents were very, very low. And Redfern Station is right next door to the park, and you're one stop into Central, right? So very close to the city. The rents out there were lower than we were getting in Parramatta and North Shore and things like that. So we're like, look, at some stage this area has to gentrify and those rents will have to move upwards because they're well under market for a lot of other fringe locations around Sydney. So we bought the Channel 7 building as our first asset in the park, and then very quickly the government put the whole park up for sale. And we actually put a joint tender in with Mirvac at the time to buy the whole park. And we bought 3 office buildings, which were all tenanted, basically government and university and things like that. And they bought the rest of it, which was a lot of car parking sites, which were going to be development sites, the old locomotive workshop, which is the old heritage building. And we got in there. So we bought our 3 buildings for $104 million at the time on very low rents. Fast forward 9 years, we sold the last asset 2 months ago. We sold that asset for $116 million.
Wow.
We sold another office asset for $104 million, and we sold the smallest one for $20 million. So we bought that portfolio for $104 in total. So investors made 280% return, 20% IRR.
Wow.
They were getting an average 8.5% income return along the way, and it was a 9-year journey.
Yeah.
Great example of just looking at a location, seeing value. You'd have to have a vision. It was going to take time. It probably moved quicker than we thought with the government putting the park up for sale, but really, really good returns because of that. A recent acquisition, we just closed a fund called the Centuria Port Adelaide Industrial Fund. Really big industrial estate in Port Adelaide. It's about 32 hectares. It's 14 individual buildings. It's about 175,000 metres of actual industrial space, so it's huge. It's the biggest industrial deal ever done in Adelaide.
Oh, wow.
Now, this has been on and off the market for probably 3 or 4 years. We've been looking at it. We're big owners in Adelaide. We've got 6 office buildings in the CBD. We have 15 industrial facilities. We're developing 3 more industrial facilities at the moment. So we know the market really well. And what we could see with this estate was the rents were low. The rents were averaging about $90, just over $90 a metre. We knew we were building new stock and getting $150 a metre plus. So we knew there was a lot of room there to get those rents up. So this was a $220 million purchase. We went out to the market. It was a single asset fund. Like we said, we went out to both retail and wholesale investors, offering an average return of about 8.5% and an IRR of about 15%. So really attractive metrics. And we're actually bowled over in the rush. It was quite amazing. So we closed it early. We could have raised about $300 million for the $115 million we needed to raise of equity.
Wow.
So that closed early, quite heavily scaled back. So if you made an investment, you actually got about half what you wanted. So we haven't seen that for a while, but I think what we're seeing in the markets is you've seen valuations now stabilise and start heading up the right way. So we had 3 years since COVID of an interest rate, really aggressive interest rate moves of being pretty tough for property. And you've seen vals drop down as cost of funding's gone up.
Yeah.
Industrial was probably the first to move and their vals have been going up for the last 3-6 month periods. But most of the other sectors have just stabilised. In our office REIT, for example, we had valuation uplift across the portfolio for the first time since 22.
Wow.
So this is a really good time to invest, right? So normally in distress, so if you go back a couple of years, right in the middle of all the interest rate moves, there was a lot of bargains out there, but are you buying a falling knife? A val's going to keep going down. What investors are seeing now is, actually vals are stabilised, so the risk of them going down has diminished, and you'll probably ride the up cycle now. So hence, I think a lot of the demand for real estate coming back into the market.
So let's dig into the office component then. Like, what are the drivers that are or the signals that you're seeing that are sort of saying this is the upshift? Like, what has materially changed in people's
viewed. And office has been the hardest sector, right?
Yeah.
Work from home's really hurt it since COVID. And if you look at our portfolio, our average occupancy rate's about 95%, so really high. But office is 90, all the other sectors are in the high 90s. So and 90 is not disaster, it's still pretty good, but it just shows you the differences between the different sectors. And Australia hasn't been hit nearly as hard as some places in the US and Europe on that office story. But look, it is turning. I think one of the big things with office is demand and supply. So it's the main thing with all real estate, right? And what we've seen since COVID is the cost to construct assets. Okay. All assets, particularly office. And they've risen dramatically. So pre-COVID, you want to build an office building in Sydney, buy the land, build it, and tenant it out. It costs about $10,000 a metre.
Okay.
Fast forward to now, it's about $15,000 a metre. And what that means is the rent a developer needs to get to make that development stack has increased significantly. So, it was probably about $600 a metre pre-COVID, and now to get a development to stack is probably $1,000 a metre. Ooh. The issue is, if you look at our office portfolio, our average rent's about $600 a metre.
Right.
So the market rents aren't there. So other than assets that are coming out of the ground, have been planned for some time, there's very little supply coming to the market over the next 5 years. So about a quarter of the supply from the previous 5 years is coming to the market in the next 5 years.
Right.
So I think what the market's seeing is over the medium term, the next 2 or 3 years, that lack of supply is going to catch up, right? Vacancy rates will reduce, rents will pick up, and there's a pretty good medium-term story for office.
But is the demand there?
The demand is there. So if you look across Australia, depends on the state, right? So if you look at something like Perth and Brisbane, where there weren't many lockdowns, it's basically back to normal, right? Sydney is pretty good, not back to normal, but still pretty strong. And then you look at something like Melbourne, world's longest lockdowns, a change in mindset about coming into the office. So it's tough down there, and they've probably got the worst markets down there for office. But most of the other markets are still pretty strong. We're doing a lot of leasing deals. Incentives are still probably stubbornly high. People have reset their leases over the last 5 years since COVID, right? So if they wanted to downsize, they've downsized.
Yeah.
But we haven't seen a lot of tenants downside. You've seen some of the banks and some of the bigger groups, but most tenants are actually staying the same or increasing. And we do tenant surveys every 6 months. And by far and away, the majority of tenants actually want more space and less space. So it's all sort of settled down.
Yeah.
So I think once that supply thing, thematic sort of plays out, office is actually looking pretty good. It's still going to be a grind for the next 2 years. But if you look 3 years and forward from there, it's actually probably a good story. I think that's what the market's seeing. So if you look at the listed markets, there's 31 real estate companies in the ASX 300 index, right?
Okay.
And of those 31 companies, 26 are up for the last 12 months.
Yeah.
I think we're second, and we're up 40-odd%. So the big institutional investors that invest into the REITs, they have definitely made a call that they think the cycle's on the way up now, and they're putting a lot of money into these real estate listed entities.
Wow. Yeah. We should make that clear. Centuria Capital Group is also listed on the ASX. The ticker is CNI. So you've got the listed REITs as well as being able to invest
as Headco, which is a listed fund manager.
Yes, yes. When it comes to investing in office buildings, are you looking for is the main priority the rental yield, or are you is it residential people are going, I want the capital growth, doubles every 10 years, so to speak. Where does it lie in commercial?
So we look at two things, right? We want to get a return out to investors, paid monthly, if it's unlisted, and we want to make some money on the way out as well. Yeah. So all our modelling looks at both. Normally if it's a very high yield, you're taking more risk. There's a reason. Poorly located, the tenant covenant's not strong, something like that. So we look at value. The big thing we look at, and having so much scale allows us to go. We know what's happening in nearly every market and most sectors in the country, and we can know, especially having, for example, 160 industrial buildings. We got buildings everywhere. Yeah. So the market or an agent might think the rent's X, and we know we've just done a deal at X plus $30. So we can go buy an asset that the market thinks is fair valued, but we know it's undervalued because we know what rent we can get. Yeah. So having scale and having 400 properties definitely helps us in that analysis of assets that are under rented. We can get the rents and the returns up to investors and add value to the asset as well. So we're always looking for total return, but real estate, historically, always strong income as well.
Now, it feels like there's skyscrapers popping up left, right and centre here in Sydney. Are you involved in any of the big ones that are popping up?
We're not. We do develop, but most of our developments are industrial and healthcare. What you'll see, goes against what I was saying about supply, but all these assets that are coming out of the ground have been in planning for 7 to 10 years, right? And some of the sites were bought even long before that. Right. So they sort of probably stack in a way because the land was very cheap that time ago. They've been in planning for a long time. They're funded and they're being built. Gotcha. To actually now go and build a new one is very hard, and you won't see those popping up for some time. Okay. So if you look at the moment, you got 55 Pitt Street down the road, which is a Mirvac. They've owned that land for over 10 years. Right. You got Chifley Tower 2, which is adjoining Chifley Tower. That land was basically free. It was part of the site, which they're now building a second tower on. So these office developments only stack in very, very rare circumstances in the current market.
Interesting. Yeah. So let's turn to the logistics side. That was offices. The other REIT that you've got is industrial and logistics. Last time we spoke, we were unpacking everything that was going on in warehouses. We spoke about your sort of positioning to capitalise on those sort of last mile retail. It's hard to ignore what's going on in AI though, and the investment that is going on, particularly overseas in data centers, but we've now seen announcements by government and also by some private players that there's going to be huge development here in Australia on the data center side.
Yep.
How are you seeing that market playing out? Are you getting involved, or is it all just sort of hype at the moment?
So yeah, look, I'll talk a bit about industrial and go into data centers. So yeah, industrial's been very strong. Australia got down to the lowest vacancy rate in the world, and New South Wales at about 0.5%.
Wow.
We've seen huge rental growth across our portfolio. Re-leasing spreads. So every 6 months, we look at all the leases that came up in that 6-month period, whether the tenant moved out and a new tenant moved in, or a tenant's lease came up and they re-signed. And what was the difference in rent afterwards to before?
Yep.
In a normal market, you've usually got spreads of 2 to 4%.
Okay.
Rents are going up out there. In industrial, we had 6-month periods where it was over 50%.
What?
So yeah, so a tenant would be paying, let's say, $1 million a year for his.
The tenants would be being like, what the hell's going on?
Tenant's paying $1 million a year one day, lease comes up, they're paying $1.5 million the next day. So this added a lot of value to industrial, right? So our portfolio has obviously done very well. That's definitely slowed down now. So the vacancy rate across Australia is about 2.8% now. Now, that is still probably the lowest in the world. So it's still very, very low. A normalised vacancy rate in any sector is probably 7 to 10%. So still very, very strong metrics in industrial.
Is that driven by the fact people now can't afford the rents, or is it because there's just more, like, people capitalised in the supply increase?
No, look, it's interesting, and we did a lot of research around rents and what it means for tenants, right? Most industrial tenants' rents a very, very small part of their cost base.
Right. Okay.
So their biggest cost base is transport, which might be a factor of 6 times their rent. So the rents can move quite significantly and not really affect the tenant, which is that's something everyone's worried about. When rents really started moving. So it's not that; it's a few things. Supply again. It's not as bad as office, but developments don't stack as well now just because construction costs have gone up. Also, getting the land, industrial land. So if you look at Sydney, all the industrial lands out west in the outer ring. And the issue out there is, and there's been a lot of land zoned industrial, however, there's no infrastructure, right? So there's no power, roading, things like that. So a lot of developments out there have been delayed, which means the market's very, very tight. Now, they're starting to free up. But the other thing that's driven industrial, which I talked about last time, was e-commerce. So as e-commerce rates exploded through COVID and will keep going up, it means you need more warehouses, to get those goods around. You don't need the shops, you need the warehouses. So, and particularly infill warehouses, so we've got, Amazon, example, on multiple properties, in and out, hundreds of vans coming in every day, but they need to be closer to demographic, can't be on the outer ring. Especially as they bring down their delivery times in Australia and try and get them close to America. That's on the industrial side, so it's still strong. On data centers, obviously been in the press every day. AI particularly driving it over the last couple of years. So you've got probably 2 types of data centers. You've got the big historical ones that are 20, 30, 40,000 metres, cloud storage, things like that. And look, we own Telstra's largest data centre, which is in Melbourne and Clayton. And we own another data centre in Perth as well. So these are traditional data centres. We made an investment in a business August last year, which is for AI factories. So that's probably the new type of data centre, which is they're specially built, they're very, very powerful just for AI. So we've had our first facility just got completed in Melbourne. It's actually the most powerful supercomputer in Australia as it stands. Never thought we'd own that, but we do. And that is just for AI. So that's just for government or enterprise coming in and using that compute to run their AI solutions. So we think we've got a big pipeline. Australia's quite far behind Asia and the US on enterprise using AI, but it's definitely coming. And we can see month on month the increase in demand for customers that need that compute for their businesses.
Is there an increase in demand from investors to be like, guys, I want to be involved in this?
Look, you've seen some massive capital raised in this space over the last 12 months. And it's definitely, it's a small part of our business right now, but it gets the most questions from the institutional investors as well as our high net worth and retail investors as well.
So one thing you've mentioned consistently throughout this is construction costs. Is the same sort of dynamic that's happening in residential property where construction costs are blowing out, approval processes from governments taking longer and longer? Like, is that all just the same in...
Basically exactly the same.
Yeah, right. And so what role does government play in commercial?
Look, the one thing is obviously planning. It's the exact same as planning just takes too long. And then on the construction costs, it's hard. you're probably more exposed to things like unions and that side of things on the commercial side, which means usually lower productivity, longer times to build things. You've seen some of the large development REITs come out and just talk about productivity and what's happening in certain states. You know, Queensland's particularly bad. I know one of the large developers up there came out and said they're probably getting 2.5 days of productivity a week on their construction sites. So for a number of reasons, right? But so yeah, it's tough out there to build. It just means that developments are harder to stack up, and it means if you've got existing assets, it's quite a good story going forward.
Yeah. You've mentioned sort of fundamental research as part of the process as well. Like, what are the, outside of, the examples that you used at the start of the episode, the driver that sort of got your attention was the low rents that kind of got you interested in the property. What other key things do you look for when you're weighing up potential acquisitions? Like, is there a sort of clear checklist where you're like, this is what we need before we even consider it going further? Yeah,
sure. Like, and we've been doing this, 30 years, and we've bought hundreds and hundreds of properties and sold them, and we know it pretty well. But we spend most of Wednesday on what we call our pipeline meetings. Okay. And we sort of have these 45-minute slots for every sector, and the teams come in for the 45 minutes. It will be the sector heads, the fund managers, the leasing teams, and we'll look at what's on market, so all the assets that are on market, all the assets that we think we can buy off market, and then other assets that we're targeting and we just want to keep an eye on and see what's happening with them. And we'll go through every single one.
Wow.
Everyone will have their view. Some of them might have managed these properties at previous, places they worked. And we really talk through it. We have all the different models up. So we have the analysts that are just going through running sensitivities, looking at rents, is under rented, over rented. We obviously go down to location, so important for real estate. So, it can be one street different, but it makes a massive difference for, say, an industrial shed. Does a truck have to go right the way around the block to get in, or can it come straight off a freeway? Things like that. So travel times. We look at, especially for last mile, demographics. So how, within 45 minutes, how much of the population could that distribution centre serve? Is it 400,000? 500,000?
Yeah.
Because we know this is what the tenants look at, right? Yeah. So they're less focused on probably rent than location. So you can get a lot higher rent if you're in the right location. Yeah, right. So we look at a lot of factors, right? And it's IP that's been built up over those 30 years, and we have a lot of experts in the room debating, is there value in that asset?
Wow.
Yeah, so it's a good way to do it.
Yeah. Do you have a dream property that you'd love to see pop up one day?
Look, we're not big in the CBDs. We're big in Brisbane and Adelaide and Canberra. And Sydney CBD, we usually trade. We'll come in and out.
Yeah.
I think it would be nice to own one of the really big office towers in the city. We're in Chifley, which Charter Hall and GIC own. Which is a fantastic building, But we've got some great buildings around the country, but some of those real trophy assets, it would be nice to have one of those in the portfolio.
You mentioned they're trading in and out. I did want to understand more about how you think about exit strategies.
Sure.
Like, when you're going into a property, like, do you have a clear, we think this is a 5-year, or are you just, holding on as long as possible?
No. We run all our analysis. Usually, if it's a fixed term fund, we look at 5 years.
Okay.
So if it's a single asset like the Adelaide one that just came up, we look at a 5-year term. The best property is something that has multiple exit strategies, right?
Okay.
So we'll have a base exit strategy that if we just do what we think is going to happen, then we'll get out. This will be the returns. In 5 years, we make all our assumptions on rental growth and cap rates and things like that.
Yeah.
And then we usually have alternative scenarios. So, for example, on the Adelaide asset, I think we got it cheap because it's very chunky for Adelaide. So, being the biggest industrial deal ever done in South Australia, a lot of people thought that's really big for South Australia. Is it too big? So, for this particular asset, we ran a base case where we just get the rents up to where we think are market, and then we sell it in 5 years' time. And that showed a really good return. Showed about a 15% IRR. Investors would get 8.5% on average on the way through. Very attractive. But then we looked at, what about if we subdivided it up and we make it into smaller lots? Can we split into 3? Can we split into 5? So our development teams go in and see, is that possible with all the facilities, with planning? And so that's an exit strategy. And then a third exit strategy for that site might be, well, we've got some older sheds on the site as well as newer sheds. Could we knock down some of the older sheds and build brand new facilities on the site as well and actually develop them out? And what returns would that show? So if you've got a property that's got multiple exit strategies, I think you're in a way better position. Yeah, but we're always looking at the exit strategy, even if it's a single asset fund or it's just going into a portfolio with a lot of assets in it as well.
Yeah, right. What are some of the selling points of going down the REIT structure versus perhaps, I guess, direct themselves, which I guess would be difficult, or is it sort of direct into one of your single asset funds?
Look, you can go into both, and it's funny. We have some investors that love the unlisted side and they won't go into listed, and other way as well. With REITs, I think you may benefit its liquidity, right?
Yeah, okay.
So, like a normal share, you tell your broker you want to sell, or you go on, online and sell your shares, and 2 or 3 days later you got the money in your bank account. Now, if you go into a fixed term fund, they're usually 5-year terms.
Right.
And with real estate, as you know, with residential, it should be held longer term, really, right? Because you got stamp duty, you've got these costs that come up when you're buying a property. So you need some time for the value to increase to get over those, and then start making a profit. But REITs give you liquidity, which is fantastic. REITs will probably usually give you a bigger portfolio, so you got diversification. REITs, you got very professional management in there. Obviously, you got high quality assets in that portfolio. Now that's listed and unlisted for us. Also, both are seen as an inflation hedge. Because you've got rents going up every year, it is a hedge against inflation. So the value of the asset should go up every year when inflation's there. So that's why it's thought of as a defensive sector.
How do you determine what goes in the REITs and like how much turnover is in there versus like just direct deals that you do?
Yeah, so it depends. Sometimes the REITs aren't always buying.
Okay.
For example, we've done very little buying over the last few years because we haven't raised equity in our REITs.
Yeah.
But and then we might have some capital on the unlisted side. If for example, we have let's say our office REIT is looking to buy, and we've got an unlisted fund that wants an office asset as well, we've got a conflicts committee. So we have a conflicts committee in-house, which is all independent. We have the chairman, who's a ethics expert, and normally we'd have a rotation system. So it's their turn to get first choice if they want it.
Gotcha.
It moves to the next.
Gotcha.
And if any sort of conflict comes up, it goes to that independent committee to make a call. But it's very rare that we have different vehicles looking at the same asset.
Yeah.
Sometimes what we have done, and we've done this on a number of occasions, we'll take it 50-50. So if both want it and it's a bigger asset, we'll own it 50-50, which works pretty well as well.
Nice.
Yeah.
Now, I know you can't give sort of personal advice, but just in general for people listening who are thinking, well, how does this compare to just going into the Mag 7, how should I think about this in terms of my portfolio? What sort of return profile should we be thinking about when it comes to commercial property over the long term? Yeah,
so if you look at the listed REITs first, you're probably getting a return anywhere from 5 to 8%. And that's usually paid quarterly or 6 monthly.
Yep.
Most of the REITs pay out that sort of way. And IRRs or total returns, look, it depends on the markets and sentiment and so forth. But let's say you're looking around that 10%.
Okay.
Something like that. On the unlisted, probably a bit higher on the way through. So, our unlisted funds are probably 7 to 8.5%. And that's paid monthly. And we're looking for IRRs probably 10 to 15%. So that's what you're looking at. Now, you're usually locked in a bit more on the unlisted funds, other than our open-ended funds that have redemption facilities.
Yeah.
But you've got, on the listed side, you've got liquidity, but you've got volatility. So whereas on unlisted, your valuations, your value of your investment only changes each time the valuation's made. Every day the market is moving on the REIT side. If sentiment's bad for some reason, something happens offshore, the share price goes down. If it's good, it goes up.
Yeah.
So it's a bit more wild ride. But you've got that liquidity. So that's the trade-off.
Nice. So crystal ball time, Jason, if we're having this chat in a decade, what do you reckon will be the biggest trends or game changers that will have reshaped commercial property here in Australia?
Look, you'll still have the traditional sectors, right?
Yeah.
You look at things like retail. There was a big scare in COVID. Everything was going on to the retail properties have been some of the strongest properties since COVID in our portfolio. We've had large format. Vals increased 5% for the last 6 months. Neighbourhoods have been really strong. So it's bounced back. Yeah. And you're going to have retail. People want to go to shopping centres, right? You'll still see e-commerce growing, but there'll still be retail there. You'll still have office. Industrial, you need more and more as e-commerce grows. The big thing is AI and data centres. And as we talked about, it's the rage. There's a lot of capital flowing into it. You're seeing all the big guys, the Microsofts and AWSs and Googles and Oracles pump hundreds and hundreds of billions and trillions into this space. As I said, we're really interested in that AI factory side, and you'll see these scale up significantly. And there's been some announcements recently about where that's heading. So as AI becomes more prevalent throughout the world, you'll really see more and more of those built.
Yeah.
And they'll just be these hugely powerful computers helping drive AI.
Yeah, well, the investment that's going on over in the States at the moment in that space is just phenomenal.
Huge. That is.
Yeah, I only imagine it's going to increase here.
I saw an interesting graph a couple of weeks ago, and what it showed was office construction in the States over the last 10 or so years versus data center construction. So if you go back 10 or so years ago, US was building about $42 billion worth of office buildings a year, and there's $2 billion of data centers. Right, it peaked just before COVID at about $70 billion of office buildings. This year, office is at $44 billion. And data centers are $42 billion. So this year they will change, and there'll be more data centers and offices built in the States. That just shows how fast it's moved.
Incredible.
In a decade, yeah.
Incredible. Yeah. Well, if you're listening and want to get exposure to what's happening here in Australia, the REITs that are available, you've got the Centuria Office REIT, the ticker is COF, the Centuria Industrial REIT, the ticker is CIP, and as we said as well, you can invest in the group, which is Centuria Capital Group, and the ticker is CNI. So you can head to the website. We'll put a link in the show notes to check out if those are right for you. But Jason, as always, so much happening in the space. Every time you come in, there's something interesting to unpack, and today was no different. So we appreciate your time.
Thank you. Pleasure.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.